Is the light turned off in your office? Because it looks like almost eerie Halloween on your face.
I was going to mention the same thing. Looks kind of.
Let's see if I can.
It was like,
like Uncle Fester.
Yeah. All right, this is episode 29. Today we were talking about how the Joe Rogan controversy will affect Spotify's stock price if the answer to high national debt is abundance instead of austerity. And we have 4 lightning round questions at the end of the show. In December, a group of over 250 doctors and public health officers published an open letter chastising Spotify for allowing Joe Rogan to spread COVID-19 misinformation, specifically citing Joe's conversation with Dr. Robert Malone, an infectious disease expert who compared the pandemic policies to the Holocaust. Since then, celebrities such as Neil Young have joined the effort to get Joe Rogan's podcast removed from Spotify. Spotify has made the decision to keep Joe Rogan, and as of this recording, the episode with Robert Malone is still on Joe Rogan's Spotify site. Do you think the decision to keep Joe Rogan and the Robert Malone episode will hurt or help Spotify?
Well, right now, it doesn't seem to be hurting Spotify that much. Stock is, at least as of yesterday, was down a little bit, but for now, they are standing by Joe Rogan. In 2010, they paid him $100 million to join their platform and be the exclusive podcast home of the Joe Rogan Experience. So they put a lot of money into Joe Rogan, and it doesn't seem like they want to flush that down the toilet just yet. And the biggest reason why is he is the single most listened to podcast on the platform. It's not even close. He has between 11 to 15 million listeners per episode. Like I said, nobody else is coming close. So this is kind of Spotify's golden goose. And I don't think they want to take it out back and chop its head off quite yet. It still could, though. I've read that the state of New York is threatening to sell Spotify stock out of their pension funds. And if other organizations or if other states' pension funds follow suit, that could cause a problem for share prices. One kind of side note that I wanted to go into on this is a lot of these controversies start on Twitter. And I wanted to detail why I think most of these controversies on Twitter are fairly overblown. Only about 1 in 5 Americans have a Twitter account, and only 10% of that 22% of Americans creates about 80% of the tweets that exist on Twitter. An additional 8.5% are bots. So almost everything you see on Twitter, especially outrage culture, is a tiny fraction of a percent of the American public, or they're just bots. So you're really getting just very, very squeaky wheels, but I don't think it represents the general public at all. And so going back to Joe Rogan, I don't think most Americans care at all about, Joe Rogan 10 years ago using the N-word or having somebody that they've never heard of on their program. I think it's really just a small group of people that are outraged. And right now, I think Spotify is trying to stay away from a knee-jerk reaction based on that outrage. We'll see what happens if their share price starts to suffer, though.
I think Spotify's stock can be affected in 2 major ways. One, shareholders can divest, or consumers can stop consuming. Now that's being affected in a negative way. I don't see the Joe Rogan experience or the recent content helping the stock too much. It might, but I think the big question is it going to hurt it? And I think in those 2 ways, it could be hurt. The average consumer typically has very little impact when it comes to divestiture. Most retail investors could sell their hundreds of dollars worth of Spotify stock, and it wouldn't have any major impact on the stock price overall. However, like Alex alluded to, big institutional investors could dump their shares and send Spotify stock into a free fall. I just don't see that happening on a wide scale. Stakeholders can handle bad press, but what they can't tolerate is a bad quarterly statement. So that brings us back to the consumer. People could, in theory, just stop paying for Spotify. But I don't see that happening either. I don't see droves of Spotify members unceremoniously canceling their subscription over Joe Rogan's content. It's controversial, and people tend to like controversy. Even if they hate Joe Rogan and the content on his show, I think they're more likely to tweet about it and they're more likely to post about it than they are to end their subscriptions. So when it comes down to it, I don't think Joe Rogan alone is big enough to have a significant impact on Spotify's bottom line. Now, if we wanted to talk about the future of Spotify's stock price, I would pay more attention to what the Federal Reserve is doing and less attention to who's being contentious in the media.
As we've discussed many times on the podcast, markets can handle good news, markets can handle bad news, but what they really can't handle very well at all is uncertainty. The fact that Joe Rogan is in the hot seat, I don't think so much the issue is whether or not they keep Joe Rogan. The question is whether or not woke Taylor Swift or Drake decides to say either Joe Rogan goes or I go. I think it was Alex who used the term the golden goose. Yes, Joe Rogan by far is a very popular podcaster on Spotify, but he's not the only golden goose. So you lose 3 or 4 other golden geese, and then all of a sudden, shareholders get really, really nervous. I think that what's hurt Spotify more than anything else is was it Daniel Ek? Is that the name of the CEO of the company? And Joe Rogan both have given these milquetoast, lukewarm, tepid, let's not offend anybody kind of statements out there. You can't be that way. I think it's actually healthier to be hated by half of the listening audience as long as you are adored by the other 50%. It's so much easier to get people to love you who already like you than it is to get people who hate you to like you. So these really walk the tightrope kind of responses from these CEOs. I think that's actually more damaging to the future stock price prospects than whether or not they just stuck to their guns and either fired him or kept him and then basically said, hey, we're never leaving Joe Rogan. Quit subscribing to us or not. To Drew's point about people leaving Spotify in a real huff, I wish I had a nickel for every person who said they were going to leave Facebook and actually stayed off 5 days after they said that, after the 2020 November election, because there's almost nobody on any of these alternative sites. With Spotify, people are already addicted to listening to music and podcasts on Spotify. There is no way they're leaving if they're still the premier music streamer.
I disagree with you guys a little bit in that I think if Joe Rogan does leave, I think that's really bad news for Spotify because, I mean, they're a company that's struggling to generate revenue. I mean, I think they only just started having like actual profits in the last year or so. And their big push has been to get original content that's exclusive to Spotify because they have to compete with Apple Music. They got to compete with Amazon. There's a bunch of other like, lesser platforms out there where people can put their podcasts on. I think Google Play has a podcast too, but just about any, major platform out there has a place for podcasts. Even audible.com, has you buy a book or whatever, but they have a bunch of free podcasts on there as well. So Spotify does not have any other avenues. It doesn't have gaming. It doesn't have movies. It has no books. It's just podcasts and music. And they need as much popular original content as they can get. And if Joe Rogan leaves, it's going to be an issue for Spotify because most of those listeners are probably going to pick up whatever platform he's on. And if it happens to be Apple Music or Google Play or whatever, they might as well just switch their stuff over to that instead of having to switch back and forth between different platforms. So I think it's going to be a huge issue for them. I think, Spotify should just, I think they're wrong to say, hey, I want to stick with Joe or we don't stick with Joe. I think they should, brand themselves more as like a platform. Like they're like TD Ameritrade. So we're not telling you if you should buy Ford or Coke. We're just here so that you can buy them if you want to. And we're not here telling you should listen to Joe Rogan. We're just putting it on here so you can listen to it if you want to. All we are is the medium so that you can find the people that you want to listen to. And we don't condone or endorse any of their opinions. And in my view, that's what Spotify is that you're not there to set the rules. You're just there to be the medium so that people can find, who they want to listen to. And so honestly, yeah, I think if Joe Rogan leaves, I think that's a huge issue for Spotify, and they're going to want to keep them if they want to keep growing their business. I also point out is that it really hasn't done much of their stock price. They're down like 25% for the year. They're down about 46 or 25% year to date, about 46% over the last year. A lot of that is just they're kind of part of the technology run up in 2022, and then some of the hot air has been kind of let out with some of the pullback in the technology sector. But so far, it doesn't look like Joe Rogan's had direct impact on the share price. Spotify's got some other issues, particularly content and revenue. And yeah, if Joe Rogan leaves, I think that's bad news. So,
Tom, do you think there's any probability of Joe Rogan leaving? I don't know if investors are pricing that into the model as much as Spotify keeps a castrated Joe Rogan, who is no longer the iconoclastic heterodox who is so off the wall and interesting that he now becomes a mamby-pamby, milquetoast, tepid, follows the rule kind of a guy that nobody wants to listen to, and just plays out his 5-year, $100 million contract.
I don't see that happening at all, because I think honestly is that if people want to keep listening, I mean, Joe has all the incentive, is pretty much in a really good position, because if he continues to be controversial and Spotify says, hey, you got to get out of here, they're going to have to pay him a huge portion of his contract, and then he can basically take his podcast wherever he wants and still make a ton of money doing it. I mean, before he was on Spotify, he had, thousands of listeners, was doing just fine before Spotify picked him up. And if Spotify's like, hey, you got to get out of here, he'll go back to doing just fine like he was before Spotify. So I don't think he's going to become a milquetoast at all, because I think, Spotify's in the position here where they have to make a decision. They're the ones going to get hurt.
I think, Joe Rogan, Joe Rogan got an offer from Rumble for the same price as his contract at Spotify. And if you're not familiar, Rumble is the startup video platform for right-wing minds. And I think he could be himself doing that, but he chose to stay with Spotify. So I don't see a milquetoast, lukewarm, mamby-pamby Joe Rogan staying on Spotify. If that was the case, I think he would have taken Rumble up on their offer.
Yeah, and then all of a sudden, you want people to listen to you. He didn't build his brand by being milquetoast either. I mean, he has a point of view, and frankly, he's kind of weird. Like I don't really know what he is, because I mean, he said he would if Bernie Sanders isn't running for president, he's going to vote for Donald Trump. It's like, explain how you got to that opinion. So I mean, I don't know, but I agree with you in that point. I mean, wherever he goes, he's gonna be just fine.
I like your theory where Spotify is just a platform where you can choose to listen to things, not choose to listen to things. But I think you'd have a hard time convincing the woke or the cancel culture to accept that. I think we're too deep into cancel culture that it's just almost a knee-jerk reaction.
I think Netflix dealt with the same issue with Dave Chappelle. I mean, they had that controversial French movie on. I can't remember what the deal was, but basically they fought everybody, and that everybody, there was this big cancel Netflix thing going on, and their whole thing was like, look, we're just the medium here. It's not our content. And they ended up keeping on there. And then when Dave Chappelle got himself in a bunch of trouble for making fun of like transgender people or something like that, they basically played the same card and they say, hey, look, we're just the medium. Get mad at Dave Chappelle. We're just here. And it worked out fine for them. I mean, Netflix did take a haircut, but it was not related to Dave Chappelle. And, as far as I know, people came in and bought it. So, I mean, it's worked out fine for them. And I think Spotify should take a cue from them. All right, moving on. Noah Millman, a political writer, wrote an opinion article for This Week that appeared on the Real Clear Markets homepage. In Noah's article, he states that the answer to high national debt is not austerity, but abundance. He explains that the U.S. has enjoyed a long period of extremely low interest rates, making payments on our large national debt manageable. However, if the Fed were to raise interest rates, this would have the simultaneous effect of both slowing the economy and making debt repayments more costly and put the U.S. in a tough position to deal with any future fiscal crisis. To avoid this from happening, the focus, according to NOAA, should be for policymakers to focus on creating economic growth instead of implementing spending cuts and tax increases. Do you think he's right?
Yeah, absolutely. I think it's the right model. It's been frustrating watching over the last 15 years the different economic policies that we keep swinging back and forth between. You know, after the economic crisis, we got low interest rates, but a presidential administration that seemed intent on making it harder and more expensive to grow the economy. And then as soon as we get the next administration, the Trump administration, the regulations go away, the taxes go down, but the Federal Reserve starts to get intent on raising interest rates again and making it more expensive to borrow money and grow the economy. It would be really, really nice to see low taxes, low regulation, low interest rates, and all these policies at one time meant to grow the economy. I think we've kind of seen that austerity alone is a big time failure. All we have to do is look at the EU. Look at Greece. They've been in austerity for about 10 years plus, and they're still a basket case. All the belt tightening has not done much of anything to help them get out of the hole they've been in. If you look at Italy, they've had some semblance of austerity for over 20 years now. They routinely run a balanced budget as a national economy, and they still can't generate economic growth to save their lives. You have to have both pro-growth policies and both pro-growth policies, both at the the fiscal and monetary end, the tax policies, and so I think absolutely. You know, there's only so much that you can squeeze retirees and poor people. You have to be able to grow the economy, create jobs, hire people, not just kick them out of their houses or cut their pensions.
I see where the author was going with this, working on economic growth instead of raising taxes or cutting spending. But to me, the way I see it, it's kind of like instead of slapping a mosquito that bites me on my arm, I'm going to get really good at itching. You're looking through the wrong end of the telescope. I think that encouraging policymakers to focus on economic growth instead of balancing the budget is just a way to continue bad behavior. What I'd like to see is a politician say, enough, no more. We're not going to spend any more than we make, period. I want another Andrew Jackson in office. With that said, I don't lay awake at night thinking that we're on the verge of an imminent economic collapse due to foreign investors selling their bonds or our dollars becoming hyperinflated. But I do wonder how far we can kick the can down the road before it's too late. And quite frankly, I really don't want to find out.
Last year, about this time, for our newsletter, I wrote an article on the tale of two economies. And what I illustrated was that during the COVID pandemic, half the nation did extremely well economically, and the other half did extremely bad. What happens when you have loose monetary policy like we've experienced for the last several years is that the rich who already own assets get richer, and the people who don't have assets yet, they can never get assets because the price just keeps going higher and higher and higher. Just look around at our neighborhoods. Get on Zillow and take a look at your own house. If you own a house right now, your house is worth significantly more than what people coming into the market could afford to pay. So if we saw a great run up in the stock market in 2020, 2021, not so much in 2022. But if they continue to have loose monetary policy tends to help the people who already have assets, and it makes it really difficult to grab onto the first rung of the economic ladder for those new people, those young adults who are just breaking into the economy. This Millman guy who wrote this article, I bet you anything he's part of the 50% that had good years in 2020 and 2021. He's not part of the 50% that scared to death about what his future looks like. And so it's kind of like the high school kid who's been taking anabolic steroids and says, I don't know what all this talk about anabolic steroids being unhealthy because look at me, I'm buff. I just benched 400 pounds. And then, one day he ends up, having a psychotic effect and takes out a bank or whatever and gets thrown in jail and goes, "It wasn't me. It was because of the anabolic steroids." That's what monetary policy does. Is that it's like high blood pressure. You don't really feel anything. You go, everything seems to be fine with my high blood pressure until you're dead. And that's kind of what's going to happen if we keep kicking the can down the road. It may not come economically, but it may come politically when the 50% who can never grab onto the first rung of the economic ladder say, "I'm tired of living this way. I'm going to revolt."
This was one of those articles where I was like, of course, abundance is, the point he's making is that, he wants it's good that the economy is growing when we have a high national debt. And my response was, of course it is. It's kind of like Venezuela, is that they spent, they pretty much, bet their entire economy on oil. And then as when oil prices were really high, it worked out great. And then as soon as the price of oil came down, everything collapsed. Right now, the U.S. has a extremely high national debt. And, of course, you want the economy to be doing well. Of course, you want people to be spending money and generating, taxable income and doing all these good things. Because if it wasn't, your situation would be even harder. And so I think you don't just focus on, we're trying to drive the economy, but like while you're trying to get people to, create jobs and spend money and take risk, you also want to be paring down the national debt while things are good, so that when they get bad, you're not going to be in such a tight spot. So I think, as things are going good, the Fed has kept the interest rates low for a longer time. The economy is, at least it appears to be, heating up. And, and I think they're right to start reducing some of their balance sheet, while things are good, and then keep a close eye on what happens when they start doing this. Because, if the abundance goes away and we go into a recession and we're trying to pay back, national debt at higher interest rates, of course things are going to be bad. But, we don't just focus on one thing, is that, while things are good, that's when you want to be paying off your debt. It's like, over the last 10 years, people have seen, like kind of like Joe said, at least half of the country has seen pretty good, the price of their house has gone up, their 401ks have gone up. A lot of times wages have gone up, and jobs and technology have been more prevalent. And these are the times you want to be paying off your house, even at low interest rates, because there's going to be a time when your job at Facebook goes away, because essentially there's nothing to Facebook. And if you don't have any debt, then you're going to be just fine. But if you have lots and lots of debt, then you're going to have a lot of issues. All right, I'll move on here. All right, so we'll move on to the lightning round of our show. A price to earnings ratio is the ratio for valuing a company that measures its current share price relative to its earnings per share. Amazon currently has a PE ratio of 49.6, Microsoft has a ratio of 33, Tesla's PE ratio is 190, and Ford has a PE ratio of 4. So can you tell me, what is a good PE ratio for today's investor?
Well, if you're looking for value, this is just the textbook definitions. A PE ratio around 15 is considered a bargain. 20 to 25 is considered pretty fair. Once you get past 30, 40, you're starting to get really high PE ratios, and that could indicate that a share price is overvalued.
I think we talked about this before, wasn't it? Do PE ratios matter anymore? I think the consensus was they don't. To answer your question, a PE ratio of 1 is really, really good, and then it gets worse off from there, but it might not even matter.
PE ratio is price earning ratio. I call it public enthusiasm ratio. It's like how much people are willing to pay. When you ask what's a good number for a price earning ratio, that's like me saying, what's a good price for beef? Well, I don't know. Are you talking about filet mignon, or are you talking about ground beef? It's really the function of a good PE ratio is a great company with very low debt that has a PE ratio for one reason or another. The public enthusiasm is low for a short period of time, so their PE ratio relative to their historical PE or relative to their industry is lower than normal. That's a good time. That's when a low PE is great. But if a PE is at 40 and then it goes to 50 and then it goes to 55, as long as it keeps going up and you already own it, that's good. It's only when you buy it and the PE ratio goes down that it's bad. So I think a good PE ratio is just buy a good company that's got good fundamentals that you like, that is at this point selling for less than its peer group.
Yeah, I'll agree with Joe. My analogy was just, asking somebody what's a good weight for me. Is that it depends. Are you 5'6" or 6'5"? Do you work out or do you not? It's all relative. You got to take it into context with other things. But Alex did bring up a good point. 15 is the historical has been about 20-23. 15 is a pretty decent ratio. But again, you have to take that into context with other metrics as well. Bitcoin is currently hovering around $44,000 per coin, well off its one-year lows of $29,000, but far from its all-time high of about $68,000. Is Bitcoin making a comeback, or is it going to stay locked in this range for years to come?
Oh, it's really hard to know. I read a lot of critics of Bitcoin. They basically call it digital monopoly money. So it's really hard to know how something that you can't do anything with and isn't really backed by anything, what its real value is. So if enthusiasm for cryptocurrencies keeps going up, then absolutely it's back. If people are starting to get bored with it, then who knows what the price will do.
I have no idea what the price is going to be.
That's it?
That's it. It's a lightning round. I can wax philosophically on this for a while if you like, but the fact of the matter is we don't know. And I'm not going to sit here and tell you that I do know. If you open up StockTwits or Reddit, someone who's long on Bitcoin tells you that it's going to do nothing but go up. But someone who's doesn't believe in it tells you it's going to go down. No one knows.
Yeah, I'll probably say the same thing is true. I have no idea whether we're stuck in a trading range or not. I will say that if it is digital monopoly money, there is a growing segment of the economy based on our earlier conversation about the national debt that it probably has more backing it up than say the U.S. dollar. There will be a tipping point, some point where a significant number of folks will say, I trust this digital monopoly money more than I trust the digital money printed by the federal government, at which time you're going to see the value of Bitcoin be stronger relative to the dollar.
I think it's range bound, and I'll leave it at that. The IRS has decided not to use facial recognition to help authenticate people creating online accounts after blowback from taxpayers who are concerned about the collection of sensitive biometric data. Do you think the IRS made a good decision by dropping facial recognition?
Yes, absolutely, for a couple reasons. Number one, I had to use this facial recognition software, ID.me, to defer my child tax credit payment because I wanted to get it all as a possible tax refund instead of periodic payments in 2021. It was a big pain in the butt, and do not recommend it. Number two, there are serious privacy concerns, and I know this from experience. Long ago, I worked for the Department of Homeland Security for 1.5 years, and I had to take a bunch of biometric data readings for like fingerprints and all this other stuff. And wouldn't you know it, Office of Personnel Management had a data breach, so a bunch of Chinese hackers now have all my fingerprints. So I don't know what they're going to do with them, but they have them. So there's definitely privacy concerns, and the government has a poor track record of protecting that data.
I agree with Alex. I don't have any experience using it myself. It does sound like it is kind of a pain in the butt to use. But I am concerned about the privacy issues. As far as I know, the government actually contracted a third party to create this software. So it's not even safe. It's not sitting in the government somewhere. It's a third party. So there's privacy issues there as well.
So was this jettison of the facial recognition? That wasn't part of the Voter Protection Act, was it? Oh, wait a minute. That's right. It wasn't.
No.
It just seems ironic that the same administration that is doing everything they possibly can to prevent using any sort of identification for voting is going to require you to have facial recognition to get what is you're entitled from the IRS after you overpaid your taxes. So I think they made a good decision constitutionally. I also think they made a good decision politically, because evidently they pulled this one and found out that when the November election's coming up, having facial recognition to pay your to get your tax refund probably wasn't a good move.
Yeah, I think they made a good move as well. However, I use one of those apps that ages your face by like 50 years. So I'm sure my image and likeness are on some billboard in Germany selling cheap beer. So at this point, it probably doesn't make a whole lot of difference. All right, for the last question is that the coldest parts of winter is not uncommon to find a cracked frozen chicken egg. This is because the yolk and the white of the egg expand against the shell as it freezes, and this can cause hairline or visible cracks. Do you think these eggs are safe to eat?
I have very little experience with it, but my guess would be if it cracked before it froze, it's probably bad. After it froze, it's probably okay.
Yeah, if it stayed in an environment that was below 40 degrees Fahrenheit, I'm sure it's fine. Might be kind of hard to crack and eat from that point, but I'd eat it.
I gather lots of frozen cracked eggs in the wintertime. I eat a lot of cracked frozen eggs in the wintertime. I'm of the opinion that any germ that can survive 17 below zero and then my refrigerator before I eat it probably deserves to make me sick.
You just put up with the salmonella.
That's right.
Yeah. I'm the complete opposite opinion. There's no way I'm eating that. Yeah, the egg itself is very secure against bacteria as long as it has not either gotten wet or damaged. I will eat that egg, especially when you pull it out and there's like chicken feces on your egg. But as soon as that shell is cracked, there is no way I'm eating that. Absolutely not. All right, well, that is it for episode 29 of Farm to Markets. We'll see you next week.